there are things that happened that are going on right now that don't make sense. And we're going to get to it, because what we've seen this week is something that we've never seen before. I think we mentioned last week a term that many people probably haven't heard of yet, which is backwardation. And to kind of just put it in a nutshell, and then you can definitely, because you know a lot more about it, discuss what backwardation is. Basically, when the spot price or the cash price for any metal exceeds the futures price, that is what we call backwardation.
Gold has just surged past $4,100 an ounce, while silver has exploded beyond $53, sending shockwaves through the global precious metals market. The world's largest mints and dealers are now in full-blown panic, with nearly half of all U.S. silver dealers halting new orders altogether. Even the Perth Mint has officially suspended silver sales, citing overwhelming demand and a global supply shortage. According to Andy Schectman, this isn't a routine market fluctuation, it's the beginning of the paper-silver system's collapse. Signs of deep stress are everywhere. Backwardation, vault depletion, and sky-high 100% lease rates all point to the financial plumbing of the precious metals market seizing up. In this report, Schectman exposes what's unfolding behind the scenes and why it could represent a historic turning point for gold, silver, and the US dollar itself. If you value clear data-oriented insight, please like the video and subscribe to the channel and turn on the notifications bell for more videos like this. We appreciate the support and hope you enjoy the video.
And this time alone, the COMEX joined the London market, where the silver price structure has been in backwardation for the recent weeks. And when we have sufficient physical metals available in the market, the cash price or the spot price for immediate delivery is typically lower than the futures price, maybe by about typically 20, 30, 40 cents around there.
At least.
That's around that.
But it's the cash value of money. The further out you go, it's like lending someone money. If you lend someone money and they're going to pay you back immediately, there's not much of a VIG. If you lend someone money and you're going to take it in 6 months, you should have to pay more.
Correct.
Right?
And when the spot price, what we've seen now, surges above the futures price, it's an indication that there's urgency in the market to source that metal for immediate delivery.
Right. The normal structure is called contango. And contango is when futures trade above spot, which reflects the cost of storage, reflects the cost of financing and insurance. And we are far from contango right now. We are, as you mentioned, in the biggest backwardation I've ever seen. It signals urgent demand. It signals depleted inventories. It signals a systemic shortage of deliverable bars. Give me my bars now. I don't want to take your promises into the future.
This is one of the things that I wanted to go over that you might say that, well, you might not be proud. I mean, who knows? But one of the things that I had researched when we were starting to look at the backwardation was in May of 21, the LBMA admitted that they overstated the London Vault holdings of silver by about 106 million ounces.
Yeah, well, they only have a free float right now of 140 million. So what does that tell you?
Well, around the same time, SLV silver holdings, especially in London, it spiked significantly when a lot of people, and David Jensen, give him the quotes on it, noted it. And he had actually said that let me just bring up his quote. He said, quote, "The demand for silver may temporarily exceed available supply that is acceptable for delivery to the trust. Authorized participants may be unable to acquire sufficient silver that is acceptable for delivery to the trust due to a limited then available supply coupled with a surge in demand for the shares."
You know when that happened? That happened actually in February of 21 during the silver squeeze. So much silver piled into, or so many people bought shares that they, over the weekend, State Street, which is BlackRock, changed the prospectus to basically say, yeah, there might be more demand than there is silver in the trust.
Well, our infamous leader just brought exactly what we're talking about. The question is, was the LBMA's 100 million ounce overstatement related to the 100 million ounce temporary spike in SLV's London Vault holdings?
Probably, and it was did
BlackRock issue SLV shares without
well,
actually
no,
buying
it's the numbskull that used to work for Goldman Sachs. His name was I forget his name, but he said that that the banks are the shorts, that they take the money, or the metal that goes into SLV, and they short it, which they should never do because it's a proxy. You would not short metal because the metal is supposed to be 1-to-1 for the shares. And if you're shorting the metal inside of SLV to drive down the price, you're in essence borrowing people's shares without their permission.
Correct. So that's listen, my take is it's a little bit more than coincidence. I don't think it's the alcohol talking.
No, not yet.
Not yet.
Let me
We'll
finish
see.
this drink.
Yeah,
it might
go.
be, but
Let's
the
go.
delivery strain is extraordinary. In October alone, we've seen almost 15 million ounces that have been delivered into COMEX. And when you have a $3 spread between New York futures and the physical market, there's a big problem. There's a huge problem. Not only that, the borrowing costs. Normally, the lease rates are about 0.5%. Right now, they've gone up to 100% annualized. That's worse than any time in the history of the market.
I think you should delve in a little bit more on explaining how the lease rates work.
So if you're going to short something that you don't have, you have to borrow metal to sell. Or if you have to cover something with metal you don't have, normally you could lease it very inexpensively. Now you have to lease it at 100% annualized cost. It's putting massive squeezes upon the big banks. But look at it from companies like ours, okay? So if I buy 100,000 ounces over the counter, spot, right? If I buy 100,000 ounces, the only way I can hedge it is with the New York futures with the COMEX contract. But if the COMEX contract is $3 back a spot, how does that work? It doesn't work. I'm hedging something $3 lower than what I have to pay for it in terms of over the counter. In other words, the futures are way lower than the physical. So I pay this physical for $10, but I can only hedge it at $7. That's a problem.
One of the things that we really should talk about, because as much as metals have moved, one of the things that has happened is there has become an enormous spread between the bid side of silver and the ask side of silver.
That's what I just talked about. That's
so. But explain to it, because if somebody calls us in today or tomorrow and says, Andy, I want to sell 2,500 ounce bars, and we give them a number, we have to go off the bid side of spot. And that's going to be a bit strange when they're seeing it trading.
Right.
So explain it a little bit.
Well, let me read something to you. My dear friend Michelle McCory just sent me, because I think it's important to understand. She sent me this. This is from the Perth Mint. I can't validate it, but Michelle is a pretty smart gal, and she said this is what she just heard. Perth Mint suspends silver sales amid global shortage. Australia's Perth Mint has halted all silver product sales due to overwhelming demand and supply chain issues, while U.S. dealer Commercial Rare Coins and Precious Metals has frozen transactions as of October 13th, 2025. The shortage stems from industrial demand in solar panels, electronics, and EVs, outpacing mine production by hundreds of millions of ounces annually, driving spot prices above 50. That's not the reason, but that's part of it. Per ounce, and record premiums on physical bars. Experts highlight plummeting London vault inventories and refining capacity strains as key factors fueling potential further price increases. So the bottom line is simply this. Again, if I buy back metal from people, I have to hedge it. If we have 1 million ounces of silver in our warehouse and the price goes down by $1, we're dead. We lost $1 million. So we have to hedge it. But if able to hedge it with contracts, it's $3 back. What do? We have no choice. And if you look around, you'll see this is not just Miles Franklin. This is every company in America. Everyone's freaking out. Half the companies aren't even taking orders. Our supplier, one of our suppliers this morning,
called us. Yeah,
he sent an email saying that
they're halting
all trading until we get a handle on the premiums, on the availability, and on the spread.
Reading that refiners are pushing retailers to buy back junk metal and sterling at 50% back a spot. Andy, what are you hearing? That's definitely not true.
Not true.
I think our buyback right now on junk, I want to say, I think Josh just did the rewrite. I think we're probably around 350 back, somewhere around there. So about 350 back a spot, which is extremely competitive. It might be even a little bit better than that. I don't even know. But no, it's definitely not 50%. That's for sure. All right. And then we want to go to Earn Dog B. If someone were to have 1,000 ounce bars, would this be a good time to move them into small denomination bars? So because this being huge demand and get the same amount of silver back.
If he did it into junk silver, he could probably.
No doubt. Junk silver, no matter what, even still right now, and premiums, trust me, are definitely on the rise. When we got our wholesale numbers from the large wholesalers and distributors today, silver eagles have shot up enormously in premium. You will find that right now, most dealers out there are probably going to be close to about $8 over spot for silver eagles, roughly around there. So junk silver, you can still get very, very inexpensively relative to the overall market. So definitely something to look at.
I'd also like to say people have probably read the Bloomberg article that's talking about the shipping of metal back to London. I think it's all bullshit. There is no, there's a little bit. You got traders taking advantage of that spread, but it's a cover story as far as I'm concerned to calm the nerves of the market. If supply were fine, they wouldn't need a PR rush in order to to say everything is fine, is moving back there. The physical supply just isn't there, and you can't move enough metal across the Atlantic in a fast enough time to meet urgent delivery needs, which means you're getting margin stress. People are getting margin calls and they have to deliver or do something, and it's hitting the paper market. And this means leveraged players are under severe pressure, real pressure. And this is, I guess, a hallmark of illiquidity and forced liquidations. And it's going to start to hurt some big players in this market.
This is the third person that's asked this question. So when will silver become a tier 1 asset? Any info or talks in the works?
No, but it was reclassified a critical mineral. That's correct. Nearly the same thing.
Right. They just asked the same question. Well, here's a great one. Habitat for Rockhounds, Jim Fry. What is the volume ratio of buyers to sellers at Miles Franklin recently?
No one's selling.
No one. Today, I can tell you that I personally took probably about 45 orders today. Not one of them was a sale order. Not one of them was a buyback. 45 orders is a huge amount of business for us to do.
Andy Schectman warns that what's happening in the silver market right now is beyond anything we've seen before. Both the COMEX and LBMA are locked in deep backwardation, a condition where the spot price for immediate delivery is higher than the futures price. That's not supposed to happen. In normal markets, futures trade above spot to reflect storage, insurance, and time value. But when that flips, it's a clear alarm. Someone is desperately trying to get silver. Now, Andy says this isn't a temporary glitch. It's a systemic failure. He reminds us that back in 2021, the LBMA overstated its silver vault holdings by 106 million ounces, right as the SLV ETF in London mysteriously showed a surge of the same amount. Days later, SLV quietly changed its prospectus to warn that demand for silver may temporarily exceed available supply. That was the first red flag, and today those cracks have become gaping holes in the system. The stress is now unprecedented. Lease rates that once sat at 0.5% have exploded past 100% annualized, the highest in history. COMEX futures are trading $2 to $3 below the real-world price of physical metal, making hedging impossible. The paper market has broken away from reality. Investors don't want contracts anymore. They want bars in hand right now. It's not just paper traders panicking. The Perth Mint has halted silver sales, citing supply chain breakdowns and overwhelming global demand. In the U.S., refiners and wholesalers have frozen transactions to recalculate premiums and inventory. Andy says the panic has spread through the entire industry. Half of all silver dealers have stopped taking new orders. At the same time, industrial demand is exploding. Silver is essential for solar panels, electric vehicles, 5G, and medical technology. Global demand now exceeds annual mine supply by hundreds of millions of ounces, creating a structural deficit that no quick fix can solve. Refining capacity is strained and vault inventories keep falling month after month. At Miles Franklin, Andy personally handled 45 orders in a single day, every one of them a buy order. Not one person sold silver today, he said. Nobody wants to let go of it anymore. That tells him confidence in the US dollar is evaporating. He calls it a melting ice cube, losing purchasing power by the day as the Fed buries the nation in debt. Meanwhile, gold and silver are quietly reclaiming their role as the true measure of value. Andy's message is blunt. Get out of paper. Own the real thing. This isn't speculation. It's survival. He believes we're witnessing the opening phase of a global monetary reset where real tangible assets will once again define wealth, stability, and trust.
He says this is a breakdown in confidence in the greenback as a reliable store of value. This is what markets look like when the world's reserve currency is at least partially losing its value or store of value function. It's kind of like your dollar is acting like a melting ice cube here in Aruba. He said that the denominator for all those asset prices, the dollar, is what's actually declining in value. He argues the erosion of trust in the dollar is the unifying factor behind soaring commodity prices, tight credit spreads, and strong equity markets. Real assets are well positioned to capture what the U.S. dollar has and is losing. It's true. And I don't know. I think this is just beginning. I truly do. I think it's going to get nuts.
Well, I think, and this is kind of a funny one because Costco Online had, Joe Potter says Costco Online had 10-ounce silver bars for $569.98.
We're less than that.
Way less than that. Way less than that. So, but I will tell you, inventories are definitely depleting. I would say that, and I don't know if I said it already, but without a doubt, the most common question that we had today was, do you have any silver left? We do. But
don't look.
I'm not looking.
Don't look. What do you think gold and silver are up this year to date?
Silver is going to be up roughly about 75%.
72.
Gold's going to be.
That was before today.
Yeah, gold's going to be up roughly about 56%.
54.16. Tattoo, good job.